Inflation is a term frequently discussed in economic discourse, yet its true complexities and far-reaching consequences are often misunderstood by the general public. While many acknowledge price increases, the underlying mechanisms and systemic implications remain elusive to many. This makes it a critical area for deeper exploration. The true impact of inflation on daily lives, societies, and global economies extends far beyond simple numerical shifts. It subtly, yet powerfully, redefines economic realities and social structures for millions, often without immediate recognition. This silent force continuously molds our financial landscapes. This documentary embarks on an analytical journey to explore how inflation, a seemingly abstract economic concept, profoundly reshapes the very fabric of society. We will examine its subtle, yet undeniable influence across various sectors, from individual households to international trade. Understanding this phenomenon is vital for navigating modern economic challenges. At its core, inflation is defined as a sustained increase in the general price level of goods and services within an economy over a period of time. It means that each unit of currency buys fewer goods and services than it could previously. This diminishes the purchasing power of money. A primary driver of inflation is often an expansion of the money supply, particularly when it outpaces the growth of real economic output. When there is more money circulating in an economy than there are goods and services available, prices tend to rise as competition for scarce resources intensifies. This fundamental principle underlies much inflationary pressure. Central banks play a pivotal role in influencing the money supply through various monetary policy tools, such as setting interest rates or engaging in quantitative easing. Their decisions can either stimulate economic activity, potentially leading to inflation, or curb it, aiming for price stability. This delicate balance is a constant challenge. This fundamental mechanism, the interplay between money supply and economic output, initiates a cascading series of economic effects that ripple through every layer of society. It sets the stage for changes in everything from personal finance to global economic stability. The consequences are far-reaching and complex. The most immediate and noticeable consequence of inflation for individuals is the erosion of purchasing power. As prices rise, the same amount of money buys fewer goods and services, directly reducing the real value of savings and income. This makes daily life incrementally more expensive. Everyday expenses, such as groceries, housing, and transportation, become significantly more costly over time. This ongoing increase requires households to spend more to maintain their current consumption levels, placing strain on budgets. The essentials of life demand a larger share of income. Faced with these rising costs, individuals are often forced to make difficult financial choices, cutting back on discretionary spending or even necessities. For many, inflation means adjusting expectations about lifestyle and future financial goals. These decisions have tangible effects on well-being. This situation directly impacts the standard of living, particularly for those on fixed incomes, such as retirees or individuals reliant on Social Security. Their income does not adjust to the rising prices, significantly diminishing their ability to afford goods and services. Inflation thus exacerbates economic vulnerability. Inflation significantly influences the dynamics of the housing market, creating complex challenges for both current homeowners and aspiring buyers. Its effects can be felt across property values, mortgage rates, and affordability. Understanding these connections is crucial for economic stability. It often leads to inflated property values, as real estate is frequently seen as a hedge against inflation. Investors and homeowners may purchase property to preserve wealth, driving up demand and prices. This creates a cycle where housing becomes increasingly expensive. However, while property values rise, increased mortgage rates, often a tool used by central banks to combat inflation, make home ownership less accessible. Higher interest costs mean larger monthly payments, effectively pricing out a significant portion of potential buyers. The cost of borrowing becomes prohibitive. This dual impact exacerbates existing inequalities, making the dream of owning a home more distant for many, especially younger generations and those with lower incomes. The gap between those who own property and those who do not widens. Inflation transforms housing from an aspiration into an escalating burden. Businesses face substantial challenges during periods of inflation, primarily due to rising costs across their operations. The increased prices of raw materials, energy, and labor squeeze profit margins. This necessitates difficult strategic adjustments to remain viable. These increased input costs directly impact a company's bottom line, forcing them to reevaluate their pricing strategies and operational efficiencies. Profitability becomes harder to maintain without passing costs to consumers, a move that can further fuel inflation. The balancing act is precarious. Companies may respond to these pressures in several ways: raising prices on their products and services, cutting production to reduce costs, or even laying off workers to manage expenses. Each of these actions has broader economic repercussions. Businesses adapt, but not without consequence. Ultimately, these responses can lead to a slowdown in overall economic activity, as consumer demand may decrease due to higher prices and job insecurity. This can result in increased unemployment, creating a vicious cycle of reduced spending and economic stagnation. Inflation thus impedes growth. Inflation significantly impacts a country's competitive position in international trade. When a nation experiences higher inflation than its trading partners, its goods and services become relatively more expensive on the global market. This can alter trade flows dramatically. High domestic inflation makes a nation's exports more expensive for foreign buyers, reducing demand and potentially leading to a decline in export volumes. Conversely, imports become cheaper for domestic consumers, increasing demand for foreign goods. This imbalance can strain a nation's economy. This scenario often results in trade imbalances, where imports significantly outweigh exports, leading to a trade deficit. Such deficits can put pressure on a country's currency and deplete its foreign exchange reserves. Sustained imbalances signal underlying economic issues. Consequently, inflation can weaken a nation's economic standing on the global stage. A devalued currency and persistent trade deficits signal instability to international investors and financial markets. This diminishes a country's influence and economic leverage. The value of a currency is under constant assessment in the global market, directly influenced by factors like inflation rates, interest rates, and economic stability. Inflationary pressures often lead to currency depreciation as investors seek more stable assets. This dynamic impacts global financial flows. In an inflationary environment, investors actively seek strategies to protect their wealth from the erosion of purchasing power. The goal is to find assets that can either maintain their value or appreciate faster than the rate of inflation. This shifts investment patterns significantly. They often invest in assets expected to appreciate in value during inflationary periods, such as real estate, commodities like gold, or certain stocks. These tangible assets are perceived as more resilient to currency devaluation than traditional cash savings. Diversification becomes key. However, not all investments offer equal protection against inflation. Some are particularly vulnerable to market fluctuations and economic downturns. Bonds, for instance, can lose real value if inflation rises unexpectedly, as their fixed payments become less valuable over time. Understanding these risks is crucial. This creates a complex landscape of financial winners and losers. Those who successfully anticipate and hedge against inflation may see their wealth grow, while those who do not, or are unable to invest strategically, risk significant financial setbacks. Inflation thus widens wealth disparities. Inflation profoundly affects access to education and knowledge, serving as a silent barrier to opportunity. The rising costs associated with schooling impact families and individuals at every level of the educational system. This creates a difficult environment for advancement. Rising tuition costs for colleges and universities, coupled with increasing prices for educational resources like textbooks and technology, create significant financial barriers. These costs often outpace wage growth, making higher education an increasingly unattainable luxury for many, debt becomes a major concern. This financial strain can limit opportunities for social mobility, as education is often a primary pathway to higher-paying jobs and improved life prospects. When access to quality education is restricted, individuals may find themselves trapped in lower socioeconomic strata. The cycle of disadvantage continues. Ultimately, inflation contributes to the perpetuation of existing inequalities by making educational advancement more difficult for disadvantaged populations. It entrenches social stratification rather than fostering upward mobility. Education becomes a privilege, not a universal right. Contracts and agreements, foundational elements of economic interaction, are significantly impacted by inflationary pressures. The fixed nature of many long-term contracts can lead to unforeseen consequences when currency values shift. This requires careful consideration and adaptation. The real value of future payments stipulated in long-term contracts can be severely eroded over time by persistent inflation. A payment agreed upon years ago may represent substantially less purchasing power by the time it is due. This undermines original intentions. This erosion of real value can lead to disputes and legal challenges, as parties may seek to renegotiate terms or contest the fairness of existing agreements. Businesses and individuals find themselves in unforeseen financial predicaments. Litigation becomes a recourse for some. The legal system must continuously adapt to this changing economic landscape, interpreting contracts in light of inflation and developing mechanisms to address its effects. Clauses for inflation adjustments, though often complex, become increasingly important for long-term stability. Legal frameworks must evolve. Governments are tasked with the delicate and complex responsibility of managing inflation through a combination of monetary and fiscal policies. Central banks, often independent, implement monetary policy, while elected officials control fiscal spending and taxation. Their coordination is vital. These policies often involve difficult trade-offs, particularly between stimulating economic growth and maintaining price stability. Lower interest rates might encourage investment, but risk fueling inflation, while higher rates can curb inflation, but potentially slow economic expansion. Policymakers face tough decisions. Decisions made by policymakers regarding interest rates, government spending, and taxation have far-reaching consequences for every segment of society. These choices affect employment levels, investment, consumer prices, and the overall trajectory of the economy. The stakes are incredibly high. Effective management requires a deep understanding of economic indicators, anticipating future trends, and adapting policies to unforeseen global and domestic events. It is a continuous balancing act aimed at fostering sustainable growth without triggering runaway inflation or deep recession. This challenge is constant. Surface-level assumptions often fail to capture inflation's true complexity, viewing it merely as a rise in prices. However, it is a multifaceted phenomenon deeply rooted in the intricate interdependencies of the economic system, involving supply, demand, monetary policy, and global factors. Its origins are diverse. It is not merely a statistical anomaly, but a powerful economic force with profound and pervasive effects on every aspect of society. Understanding these complexities is crucial for individuals, businesses, and governments navigating the modern world. Ignoring them leads to misinformed decisions. The long-term implications of inflation are far-reaching, shaping social inequality by disproportionately affecting those with fewer assets and fixed incomes. It can exacerbate wealth gaps, making it harder for the poor to save and the rich to preserve capital. This societal division deepens. Beyond economics, inflation can erode trust in institutions, including central banks and governments, if their efforts to control it are perceived as insufficient. This loss of confidence can fuel social unrest and political instability, with consequences felt across generations. Its impact is truly systemic. Ultimately, inflation is far more than just an economic statistic. It is a powerful societal force that redefines value and fairness. Its presence reshapes the distribution of wealth, alters investment decisions, and impacts the daily lives of billions. It is a constant re-evaluator of economic realities. It challenges fundamental assumptions about value, financial security, and the future, forcing individuals and institutions to constantly adapt their strategies. The stability of our economic systems is perpetually tested by its subtle but powerful influence. This requires vigilance and informed action. Therefore, a deeper, more comprehensive understanding of inflation is absolutely essential for informed decision-making at every level, from personal financial planning to national policy formulation. Such knowledge empowers us to navigate its challenges more effectively. It is a crucial tool for modern citizenship. This understanding is vital for fostering a more equitable and resilient future in an increasingly complex and interconnected world. By grasping inflation's true nature, we can better prepare for its impacts, mitigate its inequalities, and build more stable economic foundations for generations to come. The journey to understanding begins now.